Hi, welcome to the program for the day. Today we are going to learn about SOX testing, and that would be the practical relevance of COSO framework. Before we go into these technical terms and understand it, let's understand the practical scenario that the world economy faced in the year 2001 and 2002. Here we are talking about two companies which changed the entire accounting belief and auditing belief around the globe. We are going to talk about Enron and WorldCom. The auditing practices and the accounting practices in those days were not that effective as what we have today. We can give a thanks to the compliance requirement that was actually realized by the accounting world and the business class, that yes, we need a more stringent accounting rules and regulations in order to control the disasters that happened in the year 2001. Enron was the 7th leading company in US. It was very promising. Its business expanded the entire global. But what happened? A most promising company, the most innovative company of the year 2001 went bankrupt. The reason behind this story is bankruptcy. About this bankruptcy is the failure in the auditing and compliance and not stringent practice of the accounts. They used to book the new CEO of the Enron, Mr. Skilling used to book the profits which were to be received in future. Those profits were booked today. Now that was a violation of accounting concepts and conventions. As per the conservatism, you can book your future losses, but you cannot book your future profits. This sounds very simple, but actually it has a big meaning when it comes to accounts. So, let's talk about that. If I am recording my asset at original cost, the fluctuation in the prices of the assets do not hamper my accounting. It looks strong. But if I start recording my assets at the market value, which would be the higher than my original cost, that would lead to the manipulation of my financial statements. The more is the asset valuation, the more would be the valuation of the capital and liability. Profits would be exaggerated. If the profits are exaggerated, then the investors would invest more in that company, thinking that this company is going to give us a huge return. The share prices start moving towards the upward direction, and that also in a very awkward manner, right? So the hard-earned money of the investors, which they are putting in a company, thinking that the company is going to give them a better return, they actually end up losing their money. The money from their gratuity, hard-earned money for their entire life, was lost for these investors. Against the asset that was shown in the books was 70 billion for Enron when there was final the investigation that happened, the assets valuation decreased to 2 billion. So the asset of 2 billion was shown as 70 billion, but the loan still remained for 50 billion. That was a disaster. One big auditing firm of that time, Arthur Andersen, was dismantled. 29,000 people lost their job from Arthur Andersen, and 20,000 people lost their job in Enron. The company was no more there. In those days, in the year 2002, exactly after 9 months from the day the first time Enron problem was recognized, exactly 9 months later than that, a new compliance was created in US. It is known as SOX 2002 Act, that is Sarbanes-Oxley Act 2002. It's named after two congressmen of US, Sarbanes and Oxley. They formulated this particular act, and that act was applicable in US to all the public companies. Though the act doesn't apply in the private companies, still the private companies voluntarily they try to practice this act when it comes to compliance of their auditing, which is a very good sign. When we talk about here in India, what happened to Satyam, which was again looking a very promising company, was the non-compliance in terms of accounting practices and policies. We'll see about how these companies were involved into the misappropriation of their assets, or they were involved in non-compliance with the accounting and auditing part, as we go on discussing the SOX and COSO framework. So as you can see in my background, there's a huge information that has been put by me here, right? We'll try to see each one of them one by one. So let's come and understand what does the SOX 2002 means to us, especially for this COSO framework applicability, which is directly related to internal control. So section 302 of SOX says certify by management. That means all the internal controls that is being applied in the organization should be documented and certified by the management. Section 404 talks about the assessing those internal controls by the auditors. We cannot blindly believe in what has been communicated or certified by the management. Hence, the assessment of those certification needs to be done by the auditor. Let's understand what is internal control and what is COSO framework. So if you see this chart, which is drawn by me, this basically represents in a nutshell what is COSO framework. This talks about the different sections of the business where this COSO framework is applicable, and most importantly, what are the components of internal control and the activities. So we see we have operations, reporting and compliance on the top. Among the components we have control environment, risk assessment, information and communication, monitoring activities and existing control activities. It's applicable at the entity level, divisional level, operating unit and different functions. Now let's see exactly this internal control which we are talking about, what it is. So as per the COSO framework, internal control, which we will be representing through IC, is a process effected by an entity's board of directors, management and other personnel designed to provide reasonable assurance regarding the achievement of following objectives. So these are the objectives that we want to achieve through internal control. First is reliability of financial reporting. So the financial reporting which has been given by the management or has been prepared by the organization, there should be sufficient reliability on those information. This is done through internal control over financial reporting. So we need to ensure that there should be a sufficient internal control which suggests that the financial reporting which has been represented to all the stakeholders or which has been provided to all the stakeholders should have sufficient internal control so that those information are not manipulated. Secondly, we have compliance with applicable laws and regulations that includes compliance auditing and government auditing. So the compliance, the laws and regulations which are applicable, there should be sufficient auditing done in order to ensure that the organization is actually complying with all the applicable laws and regulations, whether the laws are related to the compliance within the organization or is imposed by the government. So this is done through compliance with applicable laws and regulations. That's one of the objectives we want to achieve through internal control. Third is effectiveness and efficiency of business operations. The business operations should be effective enough through the internal control. It should not slow down the business. It should make the business more effective